coined a new word, and that's snowballization. And I think it's a very ingenious way to describe what's going on. But what do you mean specifically by it?
Yeah, well, and to be clear, actually, we didn't coin it. We borrowed it from a Dutch academic, but we think it perfectly fits here. So it's the idea that there are already some pre-existing trends that were slowing globalization, but they've now been accelerated by geopolitics, whether it be the US-China trade tensions, the trade tensions that we think still exist between the US and Europe, and increasingly these non-tariff barriers. You mentioned Huawei earlier. This is a perfect example of where you have two spheres of economic influence in the world to whom it is important to secure their own economic and national defense future, and that requires them to raise these non-tariff barriers. It makes commerce harder, and in particular, if you're the type of company that already is producing sensitive economic material and your supply chain is in a rival economic sphere, then we think you're going to have issues going forward. There's going to be disruptions, extra costs around CapEx for changing supply chains, for example. So IT hardware, semis, telecom, these are the kinds of sectors that we think are really going to be caught in the crosshairs.
So those are the snowballizers, but there are some sectors with upside, and you call those emerging regional champions.
Yeah, so payments, for example. But the point there is that if you are a company who is not, your product is not born of production in a rival sphere, but it is around a sensitive technology, then there are going to be these incentives for your home country to sort of protect you and make sure that you're economically viable.
Michael, I'm struck by the political conversation down here in Washington, D.C., particularly about how the U.S.-China trade tensions are being impacted by the political discourse. And when so much of the zeitgeist, to coin a phrase from Tom Keene, is around China being able to wait out President Trump and wait out U.S. trade policy. But I got to be really candid here. When I'm parsing through the words of the Democratic presidential candidates, there's a lot of populist rhetoric on the left as well. So how might that, in the long term, impact U.S.-China trade relations, given the rise of populism on the left?
Yeah, I think it tells you that this the tariff dispute is only one part of the story over the long term. You can resolve this tariff dispute, but I think you're right. There's sort of bipartisan support for the need that the U.S. needs to somehow make China play by the same rules, and that's not our value judgment. That's just sort of borrowing the words from members of both parties. And so even if you were to shake hands on an agreement that de-escalates this round of tariffs, the political support's going to be there for these non-tariff barriers to continue.
And so that's just here domestically, but then when you go abroad, when you go to Europe, like we were talking about earlier in the program, Michael, I mean, it's kind of shocking to some extent to see the Europeans not in agreement, not just with President Trump, but even with some Democrats here inside of the Beltway as well, no?
Yeah, well, I think Europe is obviously sort of sorting out where it wants to position itself here on these points. But I think at the end of the day that there's still going to be incentives for the U.S. and Europe to align themselves somewhat more closely around these issues. And so while you might not see the kind of level of tit for tat that you're seeing between the U.S. and China with the EU and China, I think you're still going to see general acceptance over time of the legitimacy of those U.S. barriers.
What do you do if you're a big investor in something like technology, telecom, those kinds of industries where, as you say, that the snowball effect will be most prominent?
Well, I think if you're talking about kind of a large multinational tech company, the first thing you're supposed to do is bake in higher expectations of CapEx because you're going to have to shift your supply chains around quite a bit. And this is one of the reasons why our equity strategy team still thinks that there's more downside here, in the sense that in 2018 you had these kind of positive policy effects from tax reform and tax cuts or sort of boosting EPS. But some of that give back now around higher labor costs is going to be augmented by the fact that you're going to have to put more money into CapEx for a variety of reasons, but one of them here being supply chain diversification for a variety of economic and national security reasons.
Are there any upsides in the sense that, given that it's this kind of administration, eventually maybe things will come out as promised? Maybe President Trump is promising something that will happen, and maybe regulations will also go away.
Yeah, well, I mean, I think if you're thinking kind of short-term upside, right, the dynamic that sort of leads you to a handshake agreement and sort of a removal of the more existential fear. The more existential fear being that U.S. and China are going to kind of escalate into oblivion, into a recession. And if you want that to be resolved, we think the feedback loop is that there are substantial benefits to both sides cooperating and eventually shaking hands on a deal, but the power of markets going down and economic data weakening is that it clarifies those benefits for both sides. So we still think the end game here is that we're not going to escalate into a recession, but getting to that point almost requires that there has to be some more weakness that's demonstrated first.
Mm-hmm. So what would a deal look like? Because I'm struck by this, because with USMCA or NAFTA 2.0, for example, they need congressional ratification. No one's talking about the type of deal that would require congressional ratification between the U.S. and China. So if you don't need Congress's stamp of approval, how is an agreement or a framework of an agreement with enforcement mechanisms even really likely to be enforced?
Yeah, I mean, enforcement is incredibly tricky, right? And I think this is actually one of the reasons that the U.S. wanted to leave tariffs on initially and scale them down over time, as opposed to China wanting them to come off immediately. So, who ends up having the compromise in that situation, I'm not exactly sure, but someone obviously has to give on that point, because at the end of the day, you're talking about two sovereign countries shaking hands. Therefore, there needs to be a fair amount of trust that both sides are going to behave. Leaving the tariffs on is the U.S.'s way of trying to build trust over time, i.e. you show us that you are going to uphold your end of the bargain and we'll lower tariffs. And China wants that trust up front. So really, I think the compromise is about who's willing to show more of that trust up front and take that leap of faith up front.
You've looked at all of the industries that might be impacted in any way by CFIUS. Do you stay away from them because there's so much uncertainty?
No, I think it's just a matter of sort of rethinking what those industries' growth plans are and whether or not those changes have to be in the price. So going back to the idea of countries that fit in the Snowballization category, if
Yes.
you are a company that has a major presence in China and you're a U.S. multinational, I think you're supposed to think differently about the growth opportunity in China, but that doesn't mean that the company no longer is viable by any stretch of the imagination.